I don't think anybody doesn't know your position, but just for the record, you see growth picking up, unemployment going down, and 2 more rate moves this year. Have I got that right?
My base case is 3 for the year. We should be gradually moving toward neutral. And the other caution that I've repeated various times is while this year's growth will be strong, next year will be somewhat weaker, and by 2020, 2021, we're going to head back down to potential, which is closer to 1 3/4 to 2%. The reason I mention it, that's on my mind when I think about the shape of the Fed funds curve.
What would it take to get you to support a 4th move this year?
Continued strength in the economy, but more than that, I'd want to see some actions that suggested, to me at least, that sustainable GDP growth was improved. And so that would be things that improve growth in the workforce. It would show some policy moves that might suggest we're going to improve skill levels of our workforce, education levels. Some of the fundamental drivers would need to change for me to be more aggressive.
The Open Market Committee in its last statement put symmetrical higher up there. Yeah. With the choice of that word, what are you trying to tell the markets? That inflation may run a little bit above 2%, or that you are going to tolerate it for a while running above 2%?
I think it's probably the former. It's that inflation may run a little bit above 2%, and our job is to try to keep inflation so that it doesn't persistently run above 2 or persistently below. Now, we've been running 7 or 8 years below 2. But in the future, I would tolerate some moves above 2, but if I thought it would be persistently staying above 2, I'd want to take more policy action.
The forecast you mentioned, in June you have to make a new one for the Open Market Committee meeting. Tax cuts, trade tariffs, budget deficits, all the things that are going on in the world right now. How confident are you in what you think is going to happen?
Well, this is part of the job. You've always got all these variables changing, which makes this job interesting. And also why it's not a static thing, it's a dynamic thing. But the tax legislation, as I mentioned, for this year is a positive, but you mentioned debt. On the flip side, while it's a stimulus now, I think it may create a headwind in the out years because we're going to need to moderate debt growth. We're already at unsustainably high levels of debt growth. On the trade tariff front, I've said consistently, trade is an opportunity for the United States, particularly in North America, and I would be concerned if we don't ultimately get this trade agreement updated and agreed to with Mexico and Canada, because it's an intermediate goods relationship. It helps logistics, supply chains, it adds jobs here, and it makes us more potent in negotiating with China.
Well, in your mind, what's the biggest threat or threats to the U.S. economy right now?
Still, the biggest threat are the things that are staring us in the face. Our workforce growth is slowing because we're aging, and we're not yet making policy decisions to address that. Our skill levels in the United States are lagging the rest of the world. We rank 25th out of 35 OECD countries, and our skill levels aren't keeping up with disruption. And the last thing is we're very highly leveraged, and we just leveraged up late in the economic cycle, and I'm worried that that's going to create a headwind for economic growth. It also means in the next downturn, we may not have capacity for fiscal policy. Those things are the things that ultimately matter the most and worry me the most.
Well, non-financial corporate debt is at a record, speaking of leverage. There's a view that could be the trigger for the next real financial crisis. How do you see it?
I probably don't see that. So, yes, corporate debt to GDP is higher, but the financial sector as part of that is deleveraged. And what I'm looking for is systemic risk. If a company fails, or defaults, that's not a good thing, but it's not going to pull down or shouldn't pull down the rest of the economy. So corporate debt to GDP is something to watch, but I don't see a red flag on that at this point.
Another thing you didn't mention is oil. You're the guy in the oil patch here for the Fed. What do you see happening with oil prices, and how much of a danger is it to the economy?
It's not a danger. We're in a fragile equilibrium right now, you've heard me say before, and what do I mean by that? We're in relative supply-demand balance globally, but part of that balance is based on OPEC and other oil-producing countries agreeing they're going to cut 1.8 million barrels a day, and there's some talk that maybe they're going to revisit that. Having said that, we think for the next 3 to 5 years you're going to see sort of a volatile up and down in oil prices, with shale being the incremental supplier to global demand. My concern is not the next few years, it's in the out years. we think we may well likely get into a global undersupply situation because as prolific as shale is, it's not going to be enough to keep up with global demand, and we're not spending on long life projects. So we think there's spike risk to the upside. That would worry me, because if we're growing slowly in these out years, and then you get an oil increase or a gasoline increase, it's like a tax on consumers. But I think we're in a fragile equilibrium, in pretty good shape for the next few years.
There is always the question of when people think recession might be coming. I assume you're of the view that recession, as Fed officials are, that recessions don't die of old age, but there's a feeling in the markets that maybe we're seeing the yield curve start to tell us something. Well,
there's always some not immaterial probability of recession, as you know. What I'm worried about is sustainable economic growth. We're going to have recessions. My job is to make sure that in ups and down cycles, we've got maximum sustainable employment and price stability. And what I'm worried about right now is not these short-term cyclical questions, but I'm worried are we doing the right things to grow GDP. GDP is made up of growth in the workforce and growth in productivity, and I don't see us making policy steps to address either, and I think both look like they're going to be sluggish in the out years. We just don't notice it as much right now because we've got a very large fiscal stimulus, and up to now the Fed's been accommodative.
Are you getting less so? How do we know when you get to the point that we're starting to tighten policy?
Well, we're obviously raising the Fed funds rate and moving toward neutral. Neutral's the theoretical Fed funds rate where we're no longer accommodative. I think that level is probably in the neighborhood of 2.5, 2 3/4, which basically 0.5% to 0.75% of a point real. We're at 150 to 175 now, so in 3 or 4 moves, we will be at neutral.
Well, you said you would not intentionally vote for a policy that would invert the yield curve, but that's almost a tautology. I mean, why would you do that? The real question is, can you avoid a policy accident by raising the federal funds rate too far but not realizing it?
Yeah, that could happen because we don't control the curve, as you know. We control just the Fed funds rate. And right now, 2s to 10s is roughly 50 basis points. So this is why I've said, and others have said, every day I'm going to be watching very carefully the shape of the yield curve. And what the shape of the yield curve tells me is prospects for future growth, out-year growth, are sluggish. And so I think it's worth paying attention to that. But that's the reason why I'm saying let's just keep the base case for this year at 3. I'm not looking to increase that because I've got the shape of the yield curve and out-year growth in the back of my mind.
Well, given that, what would your outlook for rate moves in 2019 be? Are we going to see a pause from the Fed?
No, I still think we should be gradually moving toward a neutral policy. And again, neutral's 2.5 and 2 3/4, just a question of the pace. But that's still my overall view. We should be gradually moving to 2.5, 2 3/4, but watching these other factors as we move along that curve.
We are talking with Robert Kaplan, the president of the Dallas Federal Reserve, on Bloomberg Television and Radio worldwide. Have inflation dynamics changed when you look at what you think you need to do?
I think they have. And as you know, we're at a conference here that we're hosting on technology-enabled disruption. I think one of the reasons is technology-enabled disruptions, which means technology replacing people, but more importantly, consumers having at their disposal computing power that literally most companies didn't have 25 years ago. The power of what consumers can now do has shifted, and so businesses have much less pricing power. And so as it relates to inflation, it means that if a business wants to increase prices, they really aren't as able to do it, and technology is grinding that down, and globalization is a part of it too. So yeah, I think that's part of the reason, in my view, why the Phillips curve is flatter or more muted. I think the economy and the structure of it has changed.
Well, we came out of the Great Recession with companies managing the bottom line rather than trying to grow the top line by investing. Has that changed now that the economy has picked up, or are we still, because of disruption or whatever, going to see the emphasis be on cutting people and keeping wages down?
Well, companies would love to grow the top line, and obviously I work with companies my entire career, and that hasn't changed. They want to grow, but I think it's not easy, and so what you're seeing companies do is try to get more scale, in part by merging, and that's why you see so much merger activity. It's due to disruption and lack of pricing power. And the other thing you're seeing them do is continue to invest aggressively in technology. But I think when you see all this merger activity, people should probably connect that with the fact lack of pricing power, businesses are getting more scale and trying to protect their margins. And so that is having a pretty profound effect on workers. If you got a college education, all the data is showing you can probably adapt to this. Not that it won't be traumatic, but if you're a high school educated person or less, which is 46 million workers in this country, you're probably seeing your job disrupted or eliminated. And unless you get retrained, which is easier to say, harder to do, you're likely going to see your productivity and income decline. And that's the grinding and discomfort that we're seeing in the economy.
All these wonderful Texas businesses, the CEOs, are they going to be increasing investment because of the tax cuts?
From what I can tell so far, there's greater CapEx investment this year. That's the good news. The bad news is a lot of it, from my discussions with CEOs, is just moving from next year and the year after to now. Businesses, I don't think, are going to fundamentally increase their CapEx over the medium term unless they see greater demand. And because of sluggish workforce growth, sluggish out-year GDP growth, I think they're still in a cautious stance right now. They're focusing a lot more on costs and investing and trying to maintain margins and still see solid demand, but not breakaway demand.
Let me ask you something for our friends on the fixed income trading desks out there. What do you make of the drift upward in the effective federal funds rate over the last couple of months? Some see a quantitative tightening at work here that will shorten the time that balance sheet normalization goes.
Well, I think the market is paying attention to what the Fed is saying. We've got strong GDP growth, and so I think people are probably putting a little more weight on our forward guidance and our dot plot as to what we say we're going to do. But that's on the short end, and so you see that in the 1 year and the 2 year and 6 month LIBOR. On the long end, you're seeing a drift up, but not very rapid, and that's creating this flattening. So that's what I make of it.
Well, the minutes show that the Open Market Committee discussed maybe raising IOER, the top end of your range, by only 20 basis points to compensate. Is that necessary? Would you support that? Is that something we could look for in June?
I would support it, and I think this is a little bit of a technical matter. Flow of funds matter, and for listeners, this is about the mechanics of how we set the Fed funds rate, and I think a little bit of recalibration is not surprising and probably appropriate.
You think that's likely for June? I mean, is there a general feeling that you need to be?
I'm going to stay away from that and leave those discussions for within the FOMC there, and you'll see what we decide when it comes out in the minutes.
But we shouldn't be surprised. In other words, it is obviously.
I think we foreshadowed
discussion.
it. You've seen a little foreshadowing of it.
Yeah, you came to Texas from Massachusetts, and you lived for a long time in New York, two high tax, high regulation states. You come here. Anybody who comes here knows they talk about the success of the Texas economy being based on low regulation, low taxes. Yeah. Have you become a convert? Do you think they're right?
I think there's a lot of advantages to Texas, and one of the things you and I've talked a lot about, one of the things that's helped Texas over the last 15 years is migration of people and firms. 10 years ago, the population of Texas was 22.5 million. Today it's 28, 29. We think in the next 20, 25 years, it's going to exceed 40 million. And the reason I mention this, we don't talk about it enough in the United States. Population growth, workforce growth, is a key engine of GDP growth. Texas has got that. And this is a challenge for probably 30 to 35 states in the United States. Their population and workforce growth is flat to down. And so Texas has got more latitude then to collect property taxes. It's got a value-added tax. We have some taxes here that other states don't, but we don't have an income tax either at the corporate or the individual level. and you've got a very business-friendly, can-do environment. And it's been a virtuous cycle. The more people that move here and businesses, the more other businesses want to come. So Texas's prospects are very bright. I think other states can do it in a different way, but every state I talk to and every governor I talk to has got the same challenge. How do we attract workers and people and grow the workforce? That affects their investment in education, underfunded pension funds, and that's why I talk about demographics so much. We are letting the population growth in this country slide. We've had it before in our history. Immigration, and improving immigration, it could be skills-based, much more employer-based, but to think we're going to cut immigration and grow GDP, I think is going to create a challenge for many states in the country.